joining us today. We'll be discussing COVID-19's impact on our current financial markets and what you as an investor should do about it. Today we have the pleasure of having joined with us John Mongold, who is a Vice President and Senior Wealth Advisor at Wilmington Trust, holding the CFA and CPA designations. And we have Jason Howell, who is the founder of Jason Howell Company. Jason is a CFP and the author of Joy of Financial Planning, which is currently out and available at Amazon and major bookstores in the DC Nova area. It's a very good read. I had the chance to read it just about 2 weeks ago. Thank you for that. To begin, I just wanted to give a minute or two kind of round up, a quick recap on where we stand in markets today. We have just wrapped up the worst first quarter on record for US equities. Beginning in late February, we saw equity markets plummet 35%, which is pretty close to unprecedented from all-time highs. And then they proceeded to rebound about 20% from the market low, which we hit on March 23rd. And I will jump to that screen right now. Excuse me. There we go. So we saw that 20% rebound coming off the March lows. Among the hardest hit companies were small caps and companies with speculative grade debt during this time. In response to this crisis, we've seen the Fed step in to ensure investors that they will buy any and all forms of debt, including corporate debt, which is something completely unprecedented in US history. Even when we went through quantitative easing 10 years ago, the amount of bond buying we saw was limited to a certain amount. And in this case, it's been an unlimited, or they've pledged to do an unlimited amount of buying. They've also taken the massive step of extending $2.3 trillion in loans to US businesses. Again, that is just an astronomical number and hard for any investor to comprehend. So these moves by the Fed and Congress have no doubt added liquidity in our markets and have restored confidence, but we've seen also the highest number of people filing for unemployment benefits, and we certainly are already in a recession for Q2, and no one is quite sure of how long this is going to go because we don't yet have a universal plan to restart the economy. So over the next hour today, we will be discussing, as an investor or somebody who's advising a client, how should you be treating their money in this situation and what should be done to alter a portfolio given just the severe amount of uncertainty that we're facing right now. So this leads me right to the first question. So, we know from years of research, the main way an investor loses money is by trying to time the market. We see it time and time again. Human intuition is always to, buy when the market is hot, buy at the top, and then sell out at the bottom. This is obviously the exact opposite of what you want to do. We can see that on average, an investor loses about 2% per year, which we're calling the return gap, from inefficiently timing the market. Here you can see the return gap based on different types of mutual funds or ETFs out here. What this 2% return gap could reflect is, if you just stayed in a particular fund over the past 10 years, you would have averaged about a 9% return if you were in equities. But most investors, because they pull money out at the bottom and put more money in at the top, they only received a 7% return over the past 10 years. So again, that 9 minus 7, that's a 2% gap. And again, this is all due to kind of inefficiently timing markets. So the first question I wanted to throw out there is to John and Jason, how have you been keeping your clients kind of from avoiding this trap of selling out at the March bottom? Or did you kind of have a different approach where you advise your clients to scoop things up at the bottom? So I kind of wanted to first throw it out there. How did you get your clients to avoid these behavioral biases?
I'll start.
Go ahead, Jason.
Yeah, great question, Derek. And I think you started out the answer a little bit when you mentioned behavior. You know, a lot of investing in the markets has to do with behavior, what you do and when, and of course, why. And when you speak about the human inclination to essentially buy at the top and sell at the bottom, that's just a real thing. When you're working with clients as a financial planner, you have this curated group that's already made some decision to say, I'm going to work with an advisor and have them lead us, my family, in these choices that we should be making. And worst case scenario, those folks call people like John and I and say, hey, what's going on, before they make a big change. That's certainly the case. I didn't receive a lot of calls from people saying that they wanted to sell. I actually got a couple of calls, not only from clients, but also my brother, about, hey, maybe I should buy. And both calls are not actually right at that point, because whether it was my brother or a couple other folks, they weren't investing, they were looking to trade. And there's a big difference between investors and traders. And so all of my clients are investors for the long term. When it came to what they needed to do during the market bottoms, it was really just relax and look at maybe eventually, which I did do for my clients, rebalance their portfolios towards their original level of investments between equities and debt. And that's most of what we've done in concert with our clients so far, just getting them back to the percentages that they originally needed to be according to the investment policy statement that we designed on the front end. And then from there, we can look to see how the markets continue to perform. John?
Yeah, thanks. So I definitely had a few calls where selling was the subject, which was never, it's never a fun conversation to have, because it is human nature that, you want, in situations like that, there's always you really want to be doing something, right? You just want to do something. I don't know, but whatever that thing is, you just want to be able to act in some manner. And so what we kind of remind people of is, one thing, we always have a long-term approach. And I'm sure Jason agrees with that. So when we invest, we have an investment plan. We take into account risk in the markets. Do we expect a 30% drawdown? No, but it is potentially in the plan. So it's been discussed. And certainly we have very few clients, unless they're very specific about how they invest, that are just 100% in equities, 100% in the S&P 500. So they're going to feel all of that pain, right? So we believe in diversification, and we make sure that we have a long-term plan in terms of, what are the goals we want to achieve. And if you start to, and history shows that if you start to mess with that plan, even in times of volatility, it starts to jeopardize the goals that you've set for yourself. So having those conversations early, and then all of a sudden saying, wait, I can't handle this, I need to make a change. Well, you really have to remember why you were investing in the first place, and then see, okay, well, if I make this change and I never get that back, right? Because nobody can time the market. If anybody could time the market, they'd be on a beach somewhere doing it, and they certainly wouldn't be talking to us. So, or I wouldn't be here right now. So, nobody has ever proven that they can time it. So, and I remind people that if you, over the last 30 years, if you missed, I think it's 5 of the best days in the market, or 10 of the best days in the market, just 5 or 10 days in the last 30 years, your portfolio would be half of what it would be. So, since I can't time it and you can't time it, and we don't want to mess with these goals and put ourselves in a position where we won't achieve the things we're trying to achieve, the best thing to do is to stay in for the long run. And because we've taken this into account, it's in the plan, and eventually, you want to be there, and the only way to do that is long term. Before I became an advisor, I was a professional trader on the floor of stock exchanges, and that is a short-term trading job. And the thing as a professional trader, I never wanted to trade with somebody who took the long-term approach, because I knew I was going to lose. I couldn't make money on that trade. So the only edge that investors have, and to Jason's point, that was trading, not investing, The only edge investors have is to take the long approach. And that's how you make money, because none of my clients who have a lot of money made it trading in the stock market, not one. And so, you have to be a long-term investor. You have to have your goals set, and you have to stay in. That's part of the game. And times like this, it just proves the fact that you have to stay in.
Mm. Thank you, guys. So I'm going to move on. I don't have a follow-up question for that, but I will move on to the next one. So we actually had a number of people that reached out to me and were curious about kind of getting into the quant side of finance here. So I'm going to throw out kind of a quant-oriented question. How does the collapse and rebound affect your thinking about portfolio construction? We know that there's certain factors that exist in finance. These factors include, small caps, value companies, momentum, the quality of a company, whether it has high ROA or not, and paradoxically, low volatility. These kind of factors we know actually lead to excess returns in the long run. And we know that some of these factors like low volatility and quality do best when we're kind of in a contraction. But really, a lot of economists are looking at this and saying, well, we're in the strangest recession that we've ever seen because we kind of created this recession, from policy. It wasn't due to a housing collapse. It wasn't due to a war. We kind of created this thing. So we're definitely in a contraction, and we know these factors kind of do well. Is there any particular factor or kind of things that you are tilting your client's portfolio to? This could be, ever so slightly tilting. I'm not asking, are you going full into low volatility stocks or companies of high quality, but have you kind of rejiggered or kind of moved things around a little bit to kind of play around with these factors? Or is this kind of, not the biggest concern for you?
Should I defer to the CFA for the first quant question, John? And then I'll go ahead.
Happy to take it. So we added minimum volatility and quality to our portfolios, but we actually did it last year in more, not because we thought, hey, guess what, the coronavirus is coming, and so, the economy's going to shut down. Again, I'd be sitting on a beach if I knew that. But we did do it in the face of, we knew we were headed into, we had the tariffs that were going on. We were heading into an election year. It's sort of the end of the bull market. Kind of like quote unquote the end. Nobody knew it was the end, but we kind of thought we were in the late stages of the bull market. So we did add min vol and quality in, which was ended up being additive to portfolios overall. This particular, it's actually over the last, when we had the rebound, it's actually been really interesting, this rebound, because at first, it really reminded me of 2017 when we rebounded, because right as we started to rebound, dividend stocks did very well. Now that has a lot to do with the Fed cutting rates and being super accommodative, but they really rallied more than really the S&P 500 did. So which would think that value would actually do very well in that circumstance. Over the last couple days, specifically yesterday, you've really seen technology become almost like a safe haven, which I find pretty interesting. I think it's because they have just really strong balance sheets and people see them as sort of the future coming out of this thing. So if you look at the Apples and the Microsofts and the Googles and they're the ones that are really going to benefit from everything that's going on. So it's a pretty interesting rally, and from a factor standpoint, that's not really going to play necessarily. But I would say it's going to play to the quality, and quality continues to be sort of the factor that's been adding to portfolio performance. value not so much. But, as this plays out, I would imagine that quality will continue to be sort of the thing you really want to own. And then eventually, sort of when we hit the bottom, momentum will kick in there too at some point. But it's that sort of tech focus is very, I would say, different. You would think that would get hit first, but instead it's sort of instead it's sort of it's just kind of a difference in what we've seen before. So yeah.
And I'll say from our end, the biggest factor that we're assessing with clients is time. If I've got a client, and I've got a couple that are in their 70s, then now we're looking at maybe saying, have we tilted this in the past too much into equity? And that would have been a question that we should have been asking ourselves over all of the years. And so as an investor, as John mentioned, your first questions happen on the front end of your goals. And there are a couple of questions coming here in the Q&A chat. And my answer to these questions that are coming out now is, when do you need to touch the money? When do you need to start taking it out? Because if you needed to start taking it out in March, you had a problem if there wasn't money already in cash. If you need it 10 years or more from now, then you just go back to your original investment policy statement that hopefully if you're paying an advisor, that you're working with them on putting together before they put the money into the market and saying, hey, why are we doing this? And for how long should this take care of me? And where does this lead, no matter what the market does? If you're doing that on the front end, then having something happen, and we call this a black swan, right? An oddball doesn't really come out every once in a while, unpredictable, as John said, then it's like, wow, that's really interesting, but it doesn't actually affect my plan. So I'm a financial planner. John is as well. And when we work with clients on planning, we look at this kind of thing as probably going to happen at some point. But if you were going to retire within a year, there would have been some money that was maybe in bonds or maybe even cash that you could spend, and so that it wouldn't throw off your time. And so the biggest question to answer yourself around investing and how you might tilt it towards your time. If you've got more than 10 years, then you can be aggressive and assertive. If you've got less than 10 years, before you need to touch the money, not before you retire, because if you're living off Social Security and a pension, then you don't need to touch the money, then you've got more time. If you don't have those tools, or you don't have enough to take care of your lifestyle, and you're going to start dipping into those funds, then whatever amount you need year over year needs to be relatively liquid and available, so that you can manage your money along with your time.
No, excellent points by both of you. Yeah, exactly. I mean, this is getting into the nitty gritty of factors within equities, but you're exactly right. The first step here is identifying what is the time. I mean, time is the way more important factor here. Identifying that, this is the number of years I have to a retirement, or this is the amount of, this is when I'm going to start pulling money out of my IRA or my 401k. That is really the, obviously the first important factor, which determines obviously, what your relative balance is of bonds and equity. I think that's a great point to bring up before we get into factors and equities. I think that's
hey Derek, just real quick, just to add to that, and I would agree with everything that Jason said, and just as an addition, the recent changes, the Secure Act and the CARES Act have made a lot of things available from a tax perspective. So talking to your tax advisor about how maybe that would benefit you should definitely be done. It's, there are things that people don't necessarily, maybe they don't know about the fact that you don't need to take your R&D this year, and they can really, I have found over the years that if you tax efficiency within, not only within a portfolio, but outside of the portfolio, makes a humongous difference in returns. So, if you can just keep that in the back of your mind when you're talking about sort of your money in general, and being aware of sort of what changes are coming out and if they affect you or how you can benefit from them, make sure that you're doing that.
Great points. Yeah. I mean, yep. Not timing the market and being tax efficient are probably the two best things you can do.
Yeah.
Right.
Great. So I wanted to turn kind of a little bit outside the realm of equities and bonds, perhaps. but we know that recently the Fed has again pushed yields all the way back to basically zero. So this has made, refinancing mortgages and taking on debt kind of look really appealing again. So I wanted to ask, is there any particular advice you are giving clients to take advantage of kind of, we know people are hurting out there. We know unemployment's gone up 12 million people recently, but are there certain things that you could take advantage of with yields at this level? And on the flip side of this, are there areas of the economy, whether it's the debt that you're advising people to go into, or the equities? Like, we know that airlines have been suffering recently, high yield debt has been down. Are there areas that you're telling your investors not to go in? So kind of both sides. Are there areas or things that you're telling your clients to take advantage of, and then things to avoid?
Yeah, interesting question. With really all of our clients, we are staying the course when it comes to the original investment allocation that we had. We don't dabble a lot in individual securities on purpose. That's not part of what we do. There is the concept, and John's familiar with, having like that core and satellite approach, right? So maybe 80% of your money is invested a certain way, and 20%, the money on the edges, you play a little bit of games with. And so if you see American Airlines dropping 45% in their stock, maybe it's going to get bailed out. Maybe that's an option. You might think about it. When you see oil tank the way it's tanked, and you start thinking about energy, though, is now a good time to get into energy, or are we in a different world where oil won't be supported the way it's been supported? And this is why it's so difficult to be someone like John was in the past, a trader. Like that's really yeoman work, because you're not just having little concepts about the company thinking it's going to come back. You've got to know the management. You've got to know the industry. You may need to know worldwide economic factors and crunch all of that data, and then think you're better than the person on the other side of the trade, and make those decisions. And so we don't do that with our clients. It's not our bailiwick. It's not where we spend a lot of our time. A lot of our time is spending efforts in and around the goals and concerns of the client, what they'd actually like to do with their money, and then doing the arithmetic to see how we could get their portfolio to essentially do that, and what they may need to add to their portfolio, or how long they may need to work to be able to live the best life that they can live. That said, there are opportunities just by dint of the fact that, we're all home because of a pandemic. And so maybe they can manage their time differently with work, because they've figured out and they communicated to their boss that, hey, I can work from home, right? So maybe I can work a fewer hours, or maybe I can just go into the office one day less per week. And now my lifestyle has changed. And as my lifestyle changed, now I can work maybe longer in years and get to my goals that much faster. And so it's these tilts that we look at when we're looking at financial planning, letting the arithmetic work with you, with the real life stuff you're doing, the working versus the spending time with family, versus really any other hobby that you may be interested in.
From our perspective, similar to Jason, so we see it on a sort of a diversified. We look at everything as a diversified portfolio. Not that we're not, and we really don't try to be stock pickers so much. I mean, we do have analysts that are always looking at different sectors and industries and sort of what is the best thing within an industry. So, for example, in energy, do you really want to go into sort of gas and pipelines, or do you really want to go into sort of more diversified type large energy, like the Exxons and Chevrons and those types of producers? And I would say, as a general rule, when you're in these types of situations, those kind of bigger players, especially in those industries that have gotten hit really hard, those more diversified type companies, I think we'd rather, be on that side of that bet than sort of taking an individual sort of flyer on, a cruise line because they've gotten hit by 50%, right? Like, I'd rather take a broad sort of, if you want to, if you think that the long term was going to work in your favor and you want to invest in that area, I'd rather you look at sort of a broader sector than just sort of one company that just got hit real hard. That's a real quick way to lose money. I don't want to, I can't say that, Exxon or Chevron's a good buy. I can't tell you which one, but I would say if you're going to look like kind of in those areas and that's sort of something that you're interested in, I would look sort of broader than sort of things that are broader than more in, sort of specific in terms of what they do. But to Jason's point, you really need to get into sort of the management and is it, what is the long-term view of this? And is it something I'm willing to hold for the next 10 years? Because it is going to go up and down. And, if you think you're going to make a quick buck in the next 2 weeks, you could very, very easily lose that buck too. And I've certainly seen that from the trading perspective. I would say recently, if you talk about sort of yields going to zero, we recently put out some material on municipal bonds. There was really some displacement there. A lot of that displacement has come back into line, but there was definitely some, if you found decent, decent credits that weren't really sort of specific to the, to the crisis, we felt like there was some opportunity there. But other than that, we really like to focus on having a diversified portfolio across all sectors. Not only do you want to own sort of technology like I talked about before, but you probably do want to own, some energy, some industrial, some materials, and so you will get the benefit of sort of both or all of the sectors. You might want to overweight, sort of the technology sector just because it's kind of doing well right now, but even then it's probably, I would be more broadly diversified and evenly across all of them, kind of weighted to where the broad market is.
Thank you, guys.
Yes.
So this of mine really keeps with these sorts of things. And he brought to my attention that I don't know who created this ETF, but somebody was really quick on the ball here and created an ETF called Work From Home ETF. And I was just curious about your thoughts for that. I know this is completely speculative in nature, but please, anybody who's listening out, do not put, even 10% of your money into this thing. You always want to have a diversified portfolio across many different asset classes. But this was an interesting one because it basically invests in companies like Peloton, Zoom, Netflix, basically trying to take advantage of, this is the way we're kind of changing how we're living our lives in the past month. So I was wondering if you think, if you take note of this, if you think it's overrated, any thoughts on the work from home?
I'll start. I say take note of this because it's a great example. So stepping back just a little bit, the idea of the exchange traded fund was really about this. It was about saying, I want to invest in a certain sector, right? Whether it's technology, whether it's energy, and I just want to put my money there because that's the hot thing right now. Now, if you had a bunch of different ETFs that were in different sectors, then John and I might feel pretty good about what you're doing. But that's not necessarily how people purchase ETFs. Now, the majority of people do purchase exchange traded funds and mutual funds that cover the entire market. And in fact, the ones that do that are the cheapest to own. So that's something to note. I would just say this is about layers. The first layer, and especially if there's a lot of students that are on this call, this conference, the first layer is, do you have an emergency fund that'll pay your bills for the next 6 months? That's layer one. If you don't have that, then kind of forget about the stock market. The second layer is, do you have all the insurances that in case you hurt yourself or crash into somebody, that they're going to take care of those emergencies you can't afford? All right, if you've got that insurance, that's kind of like step 1 and 2, or maybe 1A, 1B. And now if you're still making extra money that you're not spending, now you start to say, let me get involved in the markets. And at that layer, when you're just beginning, John would probably agree, this is when you're going to be a little bit more passive and say, I'm going to invest in the broad market as I start to get my feet wet. But there's a little bit of a conflict here because you might be really young. And so then we would say, well, this is the time to take risks. And so what do? Well, you get the Peloton ETF or what have you, but know what you're doing. You're investing in a handful of companies that are in the same sector that are basically reacting to the same crisis. And so what you should expect is all of those are going to maybe fall at the same time. And that's if their management is as good as the other one. That's if their accounting and their rules and their business models are as solid as each other. And so it's just as much of a reach to be a trader on individual stocks as it would be for an ETF that is built like that, with just a handful of companies in the same industry. If we really wanted to give it a try, then maybe that would be part of your core and satellite approach, right? So you get the really inexpensive, broad market exchange traded funds with the majority of the money that you are willing to part with for about 10 years or more. And then maybe 10 to 20%, you involve some of your flyer ideas, right? Like this particular fund because it's logical. But then other stuff that you're interested in, that you would actually follow and you'd learn from over the next few years because you've got plenty of time to make mistakes. And as John would say, we know you're going to make mistakes. We make mistakes. But if you have time to learn, then you're quite all right.
Thank you.
Hey, Derek, I just want to jump in and ask John and Jason a question, and try not to do this too much, but this has come up within my circles where a couple people have HELOCs that they've drawn down to zero. So they have this line of credit available. And given what Derek's, one of his questions were, given that so many of these, the base rates are so low right now, I've actually had people ask, should I take out my entire HELOC right now and then use that money to invest in the stock market, thinking that the cash is basically free?
I'll let John start on that one.
Yeah, look, whenever you're taking, I certainly understand using leverage to build wealth, but I don't like the idea. Look, I don't like using leverage to build wealth in the stock market, especially if you think it's a short-term thing. It's just not a long-term strategy that I mean, that's trading. You're trading. And I don't believe in trading. I used to do it professionally, but I would say for an investor, I don't believe in it. And so I'm not one to say that's the first thing that you should be looking to do. You need to have a long-term plan. I actually think this is a really, really great chance, an opportunity to, your long-term plan is being stressed right now. Of course there's going to be opportunities, but you got to make sure that the plan you have in place is working, and that if you have the capacity and opportunity to take advantage of some of these things that are going on right now, that's great. That's okay. But make sure that and this kind of goes back to the first slide is, make sure that your emergency fund is together and completely solid. Make sure your core portfolio is together and completely solid. Make sure that, you're comfortable with the amount of debt that you have, and let's get the interest rate on that debt down to, as far down as we can. That's a great opportunity to do that. Look, if all of those things are completely solid in a situation like this, and you're good for the next 2 years, and you're like, man, I got this money sitting on the side, and I'm going to go try to do this. I don't think that that's a terrible thing to do, but if you're starting to mess with your emergency fund or your house that's a really, really bad idea. Don't do that. Don't take your emergency fund and put it at risk, or don't take your house and put it at risk. That's just not going to work in your favor in the long run. That's not how people make money.
I agree with John 100%. And I would underscore the comment John made a couple answers ago, that none of his clients are his clients because they were traders in the market, right? They probably have real businesses. In fact, I think a lot of them have real businesses, part of your expertise, John. And maybe they've been working for 10, 20, 30 years and saved. That's the reality. If Fred, if some of your colleagues are saying, I'm thinking about liquidating my HELOC to invest in the stock market, I would ask them, since they're being so forward with you, why aren't you using cash? Why do you have to use debt? Yeah. Because using debt is a very different game. You can do that. There are professional traders who use debt, and some of them do very well as professionals, and then some of them lose everything as professionals. So why are you using debt again, and not cash? Is it because you don't have the cash? And that's really where it is. When you're creating, if it's $100,000, you're creating $100,000 debt. Now your balance sheet is screwed up. And so now you have to win, versus if you were using something else because it was an excess, win or lose, it's okay. But as John highlighted, you're creating an opportunity for yourself to be badly hurt. And you wouldn't want to see that for your colleagues.
Very good points. Yeah, I see this among my students, even undergrads and MBAs. It really is a kind of a double-edged sword where we are right now. You have yields at zero, so you can take on debt. Robinhood, because of Robinhood, now you can transact and buy as many shares of stock or ETFs for zero. Expense ratios are down. You know, Fidelity has an ETF that's at zero, and this is all a great situation if you're a long-term investor, because costs are at zero. So you should access the equity premium, like putting your money in the market. But on the other hand, you know, now it's free to speculate, to gamble. And I see this among some of my MBA students and undergrads, because transaction costs are zero. They're taking on huge amounts of leverage and going into these things. And that's not how you build long-term wealth, right?
No, but that is how you build the buildings in New York.
Yeah. Very good point. Yes. Yeah. If you want to, if you want to avoid bankruptcy issues, do not take on. Thank you both. I'm going to go on to the next one. This one's actually kind of, we were just discussing on oil and Chevron and a bunch of other ones, and kind of in that kind of line of reason, we've kind of seen ESG expanding in the wake of this crisis. We've seen a number of people taking a new look at just the sheer amount of risk that is in the oil industry. We've also seen ESG kind of expand because investors are asking now for a lot of disclosure on how companies are treating their employees in this time. You know, what kind of protections are they offering? So I was wondering, have any of your clients kind of come to you with more ESG demands, and kind of what are you thinking about, you know, how the ESG space is evolving?
Go ahead, John.
So we've seen a lot of interest from ESG. I mean, not because of this environment, but just in general, we've seen a lot of interest in ESG. And I think there are a lot more. There used to be I think, and Derek, you probably know this a lot better than I do, but when SRI, socially responsible investing, was sort of came on the scene, it was sort of thought about as, well, I'm giving up return, and I'm not going to make as much, but I feel better about what I am. And the difference that I understand between socially responsible and ESG is that, you know, SRI is more, I'm going to get these companies out of my portfolio, where ESG is more, I'm going to have more socially responsible companies in my portfolio, which is, so one is exclusionary, one is inclusionary. So that inclusionary way of investing, there's a lot less feeling around, hey, I'm gonna make less on this. It's more, in terms of how the portfolio performs, and I can actually have competitive returns over time, and I can have companies in my portfolio that I can feel much better about. So that has brought about a lot of interest in ESG. We actually have an internal strategy that's ESG focused. And it's something that is certainly, our clients are asking more and more about, how can I do more ESG investing, across the portfolio, not just in sort of large cap, US type stocks. So, and I think, I think it's a really great movement. And I'm hoping, BlackRock came out with their investor letter, I think it was last year, saying, companies should have a more socially responsible focus. And that has really shifted sort of how companies are looking at it. And hopefully we go towards, a world where ESG companies are just in all portfolios. I think that would be, some people think that we're kind of headed that way. So, we've certainly seen a big interest, and we're certainly trying to put it in portfolios really across the board where we can.
Yeah, and I've had one client ask me about ESG, and it wasn't because of the recent events. And my question, back to him was, so in what way do you want ESG? And I got kind of a fuzzy answer, one or two specifics, but nothing broad enough for me to go pick funds for. And I still haven't. The reality is what ESG or SRI means to one client and one money manager and one financial advisor, they're all going to be different. Is it women on the board? Is it being carbon neutral? There are a lot of different factors that people may have in their heads. And then what people like John and I would have to do, if they know the factors, only then we need to go find the funds that could highlight those factors. And the truth around that is the data isn't really always current about the firms that may be dealing with those factors. And so then as fiduciaries, we have to ask ourselves, are we chasing something that is relatively nebulous versus chasing what really would be a fit for their plan and allowing them maybe later to contribute, to donate, to be philanthropists in and around the things that they really do believe in and care about. It's certainly a challenge that I see out there to work through. And thankfully, most of my clients haven't really asked about it. But like I said, if they did, I'd want them to be very specific. And then I think they end up being challenged by really what they know about it, which the jury's still out on exactly how you gauge some of that.
You're both exactly right. There's been a lot of articles recently just highlighting, you have all these different companies like Sustainalytics, MSCI, all of them come out with their own measures of how well the company is doing in terms of ESG. And each measure is completely uncorrelated with the other ones. So you're right, it's a very difficult thing to measure. And I think, we're at the early stages of understanding kind of how a company is dealing with ESG issues. And you can get very different results if you look at, well, does it have women on the board, or exactly, is it carbon neutral? So you're right. Thank you for that.
Sure.
One more, and then I think we're going to have time for some questions from the chat. So this kind of goes back to the behavioral issue, but we know there's a lot of hesitancy among younger people right now to put money in the market. If you're starting off in your 20s or 30s, you've seen the 2008 crash, and now you're seeing where your money evaporates really quickly. And we know from past financial research that what happens early in your life really affects your risk aversion. So we saw this with the kind of people that were born in the 1930s, 1929, 1930s, that they were just were risk averse and never really wanted to touch equities. So again, this is kind of a behavioral question, but is there anything you can do or to encourage people that they're in their 20s now to actually go out there and start dollar cost averaging their money into the stock market, the basics?
Yeah, here's what I'll do. I'll be really clear. Do it. I did this sort of, when I was in school. This is how much of a nerd I was. I worked at a bank, and at the bank in the early 90s, I would get a lot of information, and I eventually got this one fund. It was Janus Funds. They were the only firm that I could find that would let you put $50 a month and essentially dollar cost average and save. Everyone else, it was a very different world way back in the 90s, where you had to buy round lots, 100 shares at a time of a stock, and you had to pay transaction fees, if you can believe that, just to invest your money. Now you don't have to do that as of last fall. No transaction fees to trade stocks or exchange traded funds, maybe still with mutual funds, but why would you invest in those? You've got an opportunity. You mentioned 20s and 30s, Derek. If they're 20s and 30s and they're working, then there's no better account. Well, maybe there's better, but whether it's a Roth 401k, that would be better, or a traditional 401k, they can just put a piece of their paycheck, invest in the broad market, and don't think about it, don't worry about it, and let that money go. It's the right thing to do. I'm not going to explain why beyond that. If you're in your teens and you find yourself with extra cash, then you can have a lot easier of a time than I did as an 18 and 19-year-old trying to put 50 bucks away a month. Here's the rub. If I had kept doing it, I was starting this in 1993, 94, 95, 96, the market was all over the place. 98, 99, it was going crazy. I'd already sold it. I already took money out. Okay. And it's all of a sudden you wake up and you're in your 40s and you're managing a lot of different responsibilities. And that money would have come in handy at many different times in my life. And so once again, I'll be clear, go ahead and do it. You don't know why, and you won't necessarily want to do it because that money could be spent on beer, better clothes, all of which will be outdated in 20 years.
Very good point. Very good. Yeah, very good point. Yeah, I completely agree. It's all about kind of changing your perception and setting aside 5 or 10% of your check on a monthly basis. And just, it sounds weird, but the lazier you are with investing, the better. If you can just put it on autopilot and just have 5 or 10% of your money come out of your paycheck in your 20s and your 30s, and you don't try and time the market, you're kind of 95% of the way there in terms of being a great investor. So I think those are really good words of advice. We have a few minutes left. So Brett, do you think I should go to the Q&A or anything, Brett?
Yeah, we've got some stuff in the chat. And it looks like we unfortunately lost John. He might have dropped off. Hopefully we're going to be able to get him back in.
Sure.
But there's a couple questions in the chat, and then there's a few in the Q&A. So I think now, if you want me to ask the questions, and then you and Jason be the
I like that.
on this.
I think that's great. Yeah, if you can pick some good ones.
Yeah.
We'll
Derek is our resident CFA now.
Yeah, so we'll kind of try to do this as a lightning round because there are actually quite a few. So here's one. Is it important to check your investments now, or is it better to let your financial advisor handle decisions for you?
I'll take it. I think you should check it. I think you should call your advisor, have a conversation, and then trust your advisor.
Great. Yeah.
Great. Next question. I have a retirement annuity that protects from market downturns, so it's good for times like this, but due to the low returns for the long term, should I start transferring money out of it to another retirement fund that historically has higher returns? 10% is the max I can take out per year to avoid penalty.
Yeah, I think I know what you've got. Maybe a variable annuity, take out 10% per year. You're probably paying fees you shouldn't. And so I would probably go with that and take the options that you have on the table. And over the next 8 to 10 years, you'll have it all out and have a lot more control.
Yeah, this one I actually found is very interesting. Kind of the newer technology stuff or kind of newer investing methods. So I'm in my early 30s and I'm very new to all of this. Beyond my retirement accounts, the only investing I do is through my Acorns account. If I throw money into that account now, is that still buying low? Or does that concept not truly apply to something like an Acorns portfolio?
It applies. Derek, you want to go to that one?
Not too familiar with Acorn portfolios, but I would say the tried and true strategy here is always dollar cost average in, and yeah.
Yeah, I mean, you've got Acorns, you've got Robinhood. These are the popular ones for people that are younger, but you could just as easily be using Vanguard or Fidelity now, or TD Ameritrade or Schwab. They've all got incredibly low fees, in fact, 0 fees to trade, and putting a little bit of money in at a time is terrific. I'll just put the question back to you. Do you really have, let's say, enough money saved for the rest of the year to pay for your bills for the rest of the year in case you lose your income? If you don't, then you should be putting your money in cash, even at 0.2%. In fact, you can go online, get an online savings account for around 1%. So it's not really that terrible. It just doesn't beat inflation. But I'd rather you have $30,000, $40,000 in cash as an emergency fund in case something comes up than just trying to over exercise the part of your portfolio that's meant for much later. If you're investing, that's 10 years out. What do you do with the next 9 years of issues that you've got? That's cash.
Great. And then
I'm gonna add one small thing to that. I get a lot of questions from students about who are using, I guess, Robinhood or Robinhood-like things. that, you know, they get really enticed by options for long-term investments. So please, if you're in your 20s or 30s, please avoid options. The long-term expected return on this is 0, and you're going to get killed by the transaction costs. The bid-ask spread and these other things are just going to destroy your money over the long run. So please be boring, go with the SPY or some other boring stock index, and just don't play around with options, please.
John, do you ever do anything with options?
That's what I used to be an options market maker on exchange floors.
Wow.
So yes.
There's your financial advisor if you want to play options.
Yeah.
Yeah, no, trust me, I don't have anybody using options. I love to talk about them. I know more about them than I want to know, but I don't ever advise anybody. Most of the time when people talk to me about them, my advice is, here's why it won't work for you. That's basically what ends up happening. So,
No,
and sorry, I had a little bit of, yeah.
Two CFAs just told you no options. I think it's loud and clear.
Yeah.
No, assuming we have people in the webinar who run the full gamut of financial experience and financial knowledge, can you just define a couple quick terms for me real quick? Dollar cost averaging, people might not be familiar with what you're mentioning there, what you're referring to, especially if they're younger investors just starting out in their careers.
You gonna take that one, John?
Yeah, so dollar cost averaging is, so you're going to just put money to work at a certain time. So a lot of people just, you know, as your paycheck comes out, you put, you know, X amount from your paycheck into the market. Maybe you do it monthly, maybe you do it, you know, every couple of months, whatever that is, but it's that set periods of time over time. So as the market goes down, you're buying in cheaper, but over time, your average cost will be lower if the market kind of goes up and down. So that's dollar cost averaging.
Yeah, you do it automatically with a paycheck. You know, when you have a 401k, and your employer says, hey, do you want to contribute to the 401k? The answer is yes. And, you know, so maybe $147 comes out of your paycheck every 2 weeks, and you're buying whatever fund you chose. And maybe that fund is low. Maybe it's, let's say it's $23 a share the first 2 weeks. And then 2 weeks later, it's $26. And then 4 weeks later, it's, you know, $20. And like if you bought in March, it was probably $19 or $15. You got more shares for the same amount of money. And then when the market pops up, you've got more shares. And so now you have more money. So it's just a regular way, as Derek was saying, to invest without thinking. And as John was saying, it's a regular amount every time, no matter what's happening with the market. Eventually, you get an advantage.
Great. What is your thought about investing in REITs?
Scary. So REITs are real estate investment trusts. They're just basically funds put together so that other people can buy real estate and try to flip it. That's my view of them. John may say something different. You know, sometimes they've been good, and a lot of times, especially the past few years, they've not been so good. And so some logic would tell you when things are bad for a while, it's a good time to get in because they're likely to go back up. I don't know, especially when you're talking about commercial real estate. At a time when everyone's figured out we can work from home, what is going to happen with commercial real estate? I don't know, but it wouldn't be where I place my bets. And when it comes to residential real estate, the residential real estate market has been really hot in our area and in some other areas as well. But I don't know enough about real estate to be a trader of real estate. And so in that same light, REITs can be a hedge. They can be an offset because potentially they won't work the same way that other stocks work as far as up and down. But unless you're really into real estate and you know who the manager is of that real estate investment trust, I would shy away.
We have a ton, so we can continue to go longer.
One thing I'll add, yeah, keep it. I mean, I have it maybe 5% of my portfolio. Keep it, if you can, keep it in your IRA or 401k. Traditionally, they're tax inefficient vehicles. But yeah.
I have a feeling I know what Derek's going to say to this next one. Should I move money from a small cap stock fund to another fund?
I mean, I would say keep your small cap, ETF or mutual fund at maybe 10, 15% of your portfolio if you're a younger individual and you can take on that risk. We've seen small caps, I think when the market fell 35% this past month, Small caps fell, I think, 50%. So
Yes, yeah.
That's why they're asking.
yeah, you got to withstand that risk. So if you can withstand that risk, small caps over the long run do add value. So
Yeah, but this goes to what John said about what kind of tilts you're looking at. In our business, we have recognized, I think it's just common knowledge at this point, when we've had a big fall, then typically the stocks that move up faster are going to be your large quality companies that we all know that have been giving dividends, that have been around a while, great management, great leadership. So if you're trying to play a game where you see your accounts go up faster, well, then you're going to go large cap. But that's a game, because long term, over 50 years, small cap has beaten large cap. So it just depends on what game you're playing. If it's a long-term investment deal, then you're going to want to be spread out amongst all, large and small and mid maybe. So it just depends on the game you're playing.
Yeah, and I would also add, just kind of adding that to the REIT discussion. We see it as just another asset class. So it should, if we think it should be part of your portfolio, we think REITs should be part of your portfolio. REITs can do very well from an inflation hedge standpoint, and that's something that should probably be considered. So, as long as if you are invested, we think that all those asset classes at some point provide diversification. You should be rebalancing between them over time, and that should work into your advantage, over the long run. But it is a long run game.
Yeah. These are some great questions from the audience here. IMF secured $1 trillion in lending capacity recently. Do you see that as enough to stabilize developing markets in the EU funds, or still best to stay with US stocks?
First question, I don't know. Second question, I would diversify across the entire world. The US has about 50% of world equity, and the rest of the world has the other half. And over the years, over time, these smaller markets, it just makes sense. They're like small caps, these other countries compared to us. They've grown faster than the US because we're a big, fat, large cap. And so depending on your timeline, you want to invest in the entire planet. But whether 1 trillion is enough, as I think Brett said, or maybe it was Derek at the beginning, I can't wrap my mind around $1 trillion.
It's difficult to wrap your mind around the amount of money that central banks around the world are throwing at this problem and governments are throwing at it. It's very difficult. I would just echo Jason's point. Yeah. Even going as far as if you're younger, having emerging market indices in your portfolio could work too.
What are your thoughts on investing in robo funds or intelligent portfolios?
John?
Look, I think that there are benefits to having a system in place that rebalances the portfolio on a given time frame. I think that I think that there are definitely benefits to sort of model-based investing. I can't take that away, but I would also say that there are going to be times where, active management, although it hasn't been recent, but I think there are going to be times we have seen where active management does help. There are going to be times where you're going to want to make changes to the portfolio that aren't just simple rebalancing. And so, I think, this is a completely biased answer, but I think having somebody who understands your situation and can discuss sort of what makes sense from certainly from a tax perspective, that plays a big part in it. If it's just sort of a blind, hey, I'm just going to take these gains and move and rebalance my portfolio and not do that in a tax efficient manner, I think it's going to hurt you in the long run. But that being said, if you're sort of, if you think that whoever's, balancing your portfolio is doing it and they're going to time the market perfectly, and that's why you have a person doing it, that's not a good reason to sort of have a person. I think there are benefits to sort of that robotic system, but it needs to sort of be checked over time. So to kind of just check that box and close your eyes and assume it's going to work for you I don't think over the long run works.
Great. I know this one's big in every public employee's mind. Target date funds versus selecting index funds.
Depends on the target date fund. It used to be when I would see clients show me their portfolio and it was a target date fund, that they were paying a pretty high expense for something they could do easily on their own. And that was kind of my mantra. And then I recently saw target date funds that were pretty cheap. And so, my business partner will still do the math on like making a target date fund with the other options they have in the portfolio. The last person we did it with, I think we saved them like 0.5%. But then when you stretch that 0.5% over like a year, and then with the money, it was some good money. And so we showed it to them. We did all this work, and it was so close to a target date fund, at least the new ones that we saw. So if you're, let's just step back and say what it is. A target date fund is designed to say, essentially, I'm not going to touch this thing till I'm 65 or so. Is that likely? No, it isn't. But if that's the best you can do without messing around with your accounts and it's too complex otherwise, it's a good place. That's why they made them. If you'd like to take a little bit more risk and not have it made for you and moved for you and maybe have less in fees, in fact, quite likely, just may not be as big a gap as it used to be, then an overall passive fund would be a good choice.
Brett, I think we're coming up towards a little bit over 3, so maybe just 1 or 2 more questions. I don't want to take up too much of John and Jason's time.
That was my next point. We have come to an hour. Before we get to that, I do want to thank the panelists for coming on today and taking time out of your guys' busy schedule to do this. I want to thank the attendees. If you're still listening, paying attention, attendees, if you could raise your hand if you're a Mason alumni or a current student, would really love to see how many of them are out there. How many of them came today? Guys, if you can see the chat, they're coming in force, the Patriots. So awesome. Really excited to see that. Want to just remind people, on Friday we have our virtual negotiation seminar. So our webinar, please come and check that out. Some of our great management colleagues are going to be giving some tools of the trade of how to do negotiation virtually. And this is especially relevant right now if you need to talk to your boss. Probably asking for a raise isn't the best time right now, but at least, maintaining workflow, learn how to do it, because it's awkward when you try to negotiate over Zoom and you can't read body.
Over Zoom. What experience do we have?
Right. And so, I do want to thank, if the panelists are willing to spend an extra couple minutes and we can answer these questions, Derek, I'm sure can hang on a little bit longer. I'm not sure his teaching schedule, but we'll try to get to these last couple questions.
I've got a few more.
Yeah, take this time to say thank you.
Yeah, I got about 5 to 10 more minutes. So
great, awesome. And we have recorded this. This is going to be something that we will be posting in the chat as well. If you like this, if you have suggestions for other events you want Mason Executive Development School of Business to do, please let us know. Shoot myself, Derek, emails. We're pretty easy to find. Derek will be doing a monthly podcast with me or with us on these issues. So we really want to get out in front of this. One of the things that came from my former and beloved students, Evan Del Duke, so I want to give him a shout out right now, is how do you determine when the right time to rebalance a portfolio?
That's a good question. I did John, I'm looking forward to your answer on this. I did this continuing education credit thing, which we have to do for our letters or after our names, and I learned a little bit. And one of the things which is amazing for continuing education, one of the things that I learned is arithmetically, it doesn't make a whole lot of a difference for a 3 or 4 or 5% sort of movement in your portfolio, as far as like, should you be rebalancing it to the original allocations every time it moves 3 or 4 or 5% versus just leaving it alone. And so it's extra work that is not that necessary. In fact, the biggest benefit of doing that reallocation comes when there's more of a 20% move. And so if you haven't moved it yet, maybe now's a good time to move your money because of the March we had. And I certainly rebalanced my clients' portfolios because of March, because there was more than a 20% move. And so what I learned from my continuing education, and I'll defer to John and hear his opinion as well, is that the sort of the stats and the math has said that, getting up over 15% to 20 of a change is when you should start taking advantage of the reallocation, because that's when it benefits your portfolio most.
Yeah, I mean, I don't know exactly what the math would come out to be in terms of, I think there's different ways to look at it. I would say when you do get a market move like this, you certainly want to do it. It's one of those things where this is a great time to look at where your gains are. What are you in? Sometimes people really have, a negative effect of not rebalancing because, oh my gosh, I'm going to take all these capital gains. I don't want to take these gains. And so, if you have less of a gain, you can sort of take advantage of that, reallocate the assets. And it's, sometimes you can lock in losses, which is, also beneficial, to your sort of long-term rebalancing. So you definitely want to do it in a time period like this. I've seen sort of studies that say doing it on a set calendar basis actually works in your favor over time. So, you do it, you look at it quarterly and you just do it. You don't think about it, you just do it. But I would say probably to Jason's point, the incremental benefit of that is probably not that big. So you do really want to take advantage of these circumstances to do it. But, I've seen a couple different things, but I would agree with Jason.
Yeah.
Great. With very low interest rates, what alternatives to total bond index funds such as VBTLX, which include treasuries of different durations, corporate bonds, MBS, et cetera, are you looking at?
Hey, John?
I guess in the bond space, the thing is, I guess it depends on the size of your portfolio, right? If you have enough assets to be able to buy individual bonds, you should try to do that because of the efficiency. You can also just hold the bonds to maturity. Then but if you don't, and you have to have minimums for that. But if you don't have those and you're looking at bond funds, you really have to kind of dig into the bond fund to know what it owns. What are the credits? How deep do they go? If it is a bond index fund, if they're just going to sort of look at the index, and the index has a credit quality that it's looking at, does it stick to a minimum credit quality, or does it look at the average credit quality and you have a bunch of, triple B bonds or even lower than that are going to bring you risk that you really don't want? So it really depends. And then, from a tax efficiency standpoint, of course, municipal bonds are going to be different than corporate bonds. Treasuries aren't really paying a lot. So it's a really sort of in-depth question to go beyond just sort of like what other kinds of funds would you look at. I guess my answer would just be, you really just need to focus on what the underlying holdings are and how you and what you're trying to achieve. Don't just look at the yield, and I would also say look at what the fee is, because bond funds are surprisingly expensive, and that fee can really eat into your and a bond fund. I mean, if you're only going to get whatever, I'm going to make up a number. Let's say you get 2% on it, and you're paying 60 basis points. Is that really worth that? So, those are the things that I would be considering.
And to kind of echo John's point there on the fee, like if you have a 2% bond, or expected return of 2%, and then the fee eats into that, you can even look at just straight up savings accounts. There's still savings accounts out there that have this, are risk free and are paying 1.5%. And same thing with CDs. You can get a higher rate and your money's locked away for a little bit. But so you can look at things that are comparable to bonds, but different vehicles. So
I do want to bring up one point. It was mentioned in the chat of potentially doing another one of these focusing on retirees, which I think would be really interesting to get the group together. And obviously an age bracket that's got to be going through a lot of stress at night about what's happened to their retirement accounts. Do you want to get to the question? I think it was addressed in the PowerPoint, but just want to circle back so people feel their stuff's getting asked as much as we can. In order to be properly diversified, but what are your thoughts among the 11 sector groups that are currently the most attractive during the COVID-19 market?
Defer to John on that one.
Yeah, I mean, we actually don't have any sector weightings. We actually went fairly neutral. So I can't really say that we have anything where I would sit there and say, this is a sector we like. Generally, we do actually have sector weighting. So, but just given, so I am not an economist and I'm not going to pretend to be one. But I would also say that, this run up, there's a lot going on underneath the surface here. And I think Derek talked about it in the beginning. I know I'm taking this question off on a little bit of a different tangent, but You know, in the very beginning of the crisis, when we sort of started shutting down the economy, there was a lot of things that were sort of at risk. Now the Fed has sort of thrown a lot of money at that. The federal government has thrown a lot of money at that. And so a lot of the illiquidity and uncertainty in the market itself has, that we saw in the very beginning, has subsided. So, you know, I think that's some of where this rebound has come from. But I would also say beyond that, you know, the path of the virus and what happens to that and how long this lasts is still going to be there. So I think, you know, we just don't know how this is going to play out yet. And I don't want to say like the market's going down or the market's coming back or that. I mean, I don't know in depth, but the level of uncertainty here is so big that it's very difficult to say energy, you know, or industrial, or, you know, and I think everybody was kind of lean toward, I mean, just given the fact that we're doing this on Zoom, you're going to kind of lean towards technology. But we're not doing that because it's just so uncertain in terms of what the next 3 to 6 months looks like. And then, you know, and then there's questions around that. And I just, and then you're heading into an election. I mean, I just think it's really, really difficult to say, you know, I really want to lean into this one area right now. I think having a broad diversification, and even within that diversification, having diversified companies within diversification is a good thing to do. I just think that there's, you know, if you can have them play off of each other and be able to rebalance throughout a level of where we think there's going to be volatility, that's going to help your portfolio in the long run. That was such a non-answer.
No, I think that's great. And Derek and I were talking about that actually in the pre-recording before we did our podcast last week of what sectors and things. And he basically told me the same thing. And there's been some, you know, you listen to some guys on TV, you know, on Squawk Box, and they're saying, go into industrials, or, you know, that sector is going to get propped up by the Defense Production Act. But I think the point is you can't time it. You don't know which firms, you know, you're trying to pick winners and losers, and we know that doesn't work. I do want to.
I mean,
sorry, go ahead, John.
Okay, go ahead.
I was going to do.
I do have to bounce in like 1 minute. I do want to add one thing though. I would say that on a short-term basis, the market that you sort of read about or see on CNBC, I mean, that's the news, right? And the news needs to be, it's filtered and it needs to be verified, and that takes time. The market doesn't trade on CNBC. The market trades on what they think they're going to hear or what they think is going to happen, and they can trade on rumor that has not been verified. So to pretend like you know sort of what's going to happen over the next day, week, month, it could be trading on something that you have absolutely no idea why it's doing what it's doing. When you see a thing at the end of the day at the Wall Street Journal saying, people were profit taking, or this is the reason the market went up, or this is the reason the market went down. They may be trading on stuff, and it's not inside information. This is stuff that just isn't verified, and they may be trading on that. So going back to the original point, the only thing you have going in your favor is to stay in for the long run, because you don't know what's moving the market. It's impossible to tell. Yeah, we know that the coronavirus has a negative impact, but I don't think anybody would have sat there and said, oh yeah, we're going to go down 30%, come back 20. I mean, I think that's just unrealistic. I am going to have to go, but
yeah, thanks, John. I really want to thank you. There's one last I was going to get to. I'll let Derek potentially take it, but we can get to it at another time. But it was, I think Bob asked a very good.
Well, thanks guys. I really appreciate it.
Good seeing you.
Thanks, John.
All right.
And this will be our last question, then we're finally going to go. So thank you all again for coming. But one of the panelists, one of the attendees, we've been talking about the REITs, the REITs, and living in DC. It's still a hot residential market. You know, everything I'm hearing from friends in the real estate industry is that product and inventory is still moving around here. And so he said, you know, we live in a hot residential real estate market. It might be interesting to hear a bit about when to make a first-time home purchase and what opportunities might exist for creative financing, given that that's the pathway for wealth in the United States for the past 50 years.
Yeah, I'll say if you can qualify for a home loan in this area, then I guess that's your sign to make a go for it. obviously it makes some sense. And there actually has been, additional studies recently by peers of mine who've tried to compare the cost of owning a home and all of the upgrades and repairs one would do over the course of 20 to 30 years versus just renting. And it's not as obvious as we were led to believe, maybe by the Real Estate Association, that it's a total win for your net worth. That being said, this is the DC area. And so if you work on averages across the country, I think that math is probably close to correct. If you use that math on an area like ours, where the real estate market has for really 30 years just gone up, then you have a higher matrices and a higher opportunity for growing that wealth in a way that you would think, by the stories that we're told, would really be a benefit versus renting. I think stepping back and not looking at the house just as an investment, but also looking at it as part of your financial life plan will give you the best sort of up or down on buying a home today. For me, I'm in my 40s, I've got 2 kids, and the school system means a lot. And so for me, owning a home versus having a landlord say, hey, we're going to sell this place, time to go, is a big deal. Because if they say that and I can't find a school in the school system I want to be in, I've just changed the life of my kids. And so that's a problem. And so if ownership for the sense of what you need to do in your life, for the stability of what you need in your life is important, not to mention being able to paint the walls and change out the kitchen is important to you, then let that more be your guide. And then if you go talk to a loan officer and you qualify, then you can do the arithmetic and say, well, maybe this is a good bet for me. And at least you won't regret the life decision you made, regardless of how the numbers pan out.
I think that's, a great way to frame it. Also, there are these great rent versus buy calculations which factor in how long you're going to stay at a particular area. New York Times has one. If you just Google rent versus buy calculation, and really kind of echo Jason's point, it doesn't make sense to buy if you're going to stay. If you plan, if you're in your 20s and you're still moving around and you're looking for your career and you plan to stay in an area just for 3 or 4 years, you probably still should be renting at that point.
Yeah, less than 5 years is the kind of the typical rule. But then people say, well, you could rent it out. Well, then you got to take a little less because you're renting it out, and you maybe hire a management company, and it's sometimes you have to change a sink out. And it's just, if you want to be that kind of person, just know what you're getting into and you'll be better off.
Yep.
I think that's a great answer and a great one to end on. So once again, thank you all. And thank you, Jason, so much for taking time. Thank you, Derek, for putting this together. Really want to do more of these. And I think we're hitting a real need and kind of hot spot where people, really do want advice and be able to talk. And I think the answers that were provided by the panel were incredible. So thank you all for this so much. And thank you everyone for listening. Once again, tune in, and everyone have a wonderful rest of your week.
Do the same.
Thank you.